Welcome to Convince Me in 15 Minutes, where we give our guests 15 minutes to convince us about timely topics in the financial services industry. Before we begin, please subscribe below. The Convince Me in 15 Minutes podcast will introduce you to new concepts, theories, philosophies, and practices in the financial services industry. Your guides are Luke Tawas and Keith Thompson. We'll follow up the initial presentation with questions. So again, subscribe below and we'll introduce our guest speaker.
Hi, my name is Joe Boskovich Sr., and I'm Chairman and Chief Investment Officer of Old West Investment Management. And I have the next 15 minutes to convince you that gold is the safest investment in the world, and that there is a huge disconnect between the price of gold today and the price of gold mining stocks. Gold is not new. It's been around for thousands of years. It's the world's oldest investment. Interestingly, that I find it to be the safest, but I think I've told people the last few years that if I had to put all of my money in one single investment, if I was forced to do that, typically you'd say cash, and especially U.S. cash. But I would not say that today. I wouldn't say it the last few years. The Federal Reserve Bank of the United States, going back 20 plus years to Alan Greenspan, took on a new role. And that role was trying to prevent recessions. And anytime a recession was staring us in the face, the Fed would start printing money and manipulating interest rates. And interest rates are the price of money. And they're meant to be a free open market of buyers and sellers that are determining that interest rate, determining the price of money. And the Fed, when they started manipulating rates some 20 years ago, and in doing so, they've actually caused more damage than they've prevented. They're completely responsible for the housing bubble in 2005, 2006, by leaving rates too low for too long, causing the greatest housing bubble in the history of our country. And then they did it again by leaving rates too low, too long, leading up to the pandemic, and causing. I think we'll look back on the previous 5 years as the roaring 20s, when you saw cryptocurrency skyrocket and all of these other financial gadgets skyrocketing, stock market at an all-time high, companies selling at a multiple of revenue instead of a multiple of earnings. That kind of speculation was completely, not completely, but largely caused by the Federal Reserve Bank leaving interest rates too low for too long, and causing rampant speculation, which usually is followed by a severe downturn. Bitcoin and cryptocurrencies stole some of gold's thunder a couple of years ago. And I think there's some justification for that. I think the reason to own a cryptocurrency is the same as the reason to own gold, and that would be as a cash alternative, distrust of the government, acknowledging government manipulation of the currency, massive money printing, and currency devaluation. There's only one gold. It's very hard to find. It's expensive to mine, and it's limited in supply. And the other thing that most people aren't aware of is that discoveries of new gold mines have dramatically fallen. The world is not finding new gold at anywhere near the rate that they have in the past. In terms of the demand for gold, it's largely driven by central banks the last 5 to 10 years. You have central banks of China and India and Singapore and Turkey, many companies accumulating massive amounts of gold. The World Gold Council, interviewed many of the central bank leaders and asked them, why they're accumulating so much gold. And they said that the main reasons were that gold acts as an inflation hedge, it's a diversifier, and its performance during times of crisis were the main reasons that they were accumulating it. So I don't think any of those are going to change. The recent rally, gold just reached an all-time high of it breached the old high of 2 years ago of 20.65 an ounce. It breached that recently, but it's still far off the all-time high in real terms. In nominal terms, it's at an all-time high right now. But if you look at the historical high price of gold in 1980, it reached $850 an ounce, which was a record at that time. Well, that price in today's dollars is $3,200 an ounce, and so there's a big difference. Today's 2040 an ounce versus the real all-time high of 3,200. So I fully expect it to breach that all-time real high in the next few years, and then the opportunity. But we don't own gold. We own mining companies, and everything about our company and all of our portfolios and all the work we do are about companies, not about the commodity. And trying to find the best companies run by owner managers. But I think there's an extraordinary opportunity right now because the delta between the price of gold and the price of the gold mining companies is the delta's at an all-time high. And so what is the reason for that? Well, there's several, but probably first and foremost is in past, going back 50 years, in every gold bull market, the gold mining companies would take the profits and they would buy other companies. They would recklessly buy properties looking for more gold. They just weren't good capital allocators. And I think that they've actually found religion. And I think that they're the big mining companies. Our favorite is Barrick, but I think that they are first and foremost concerned about their balance sheet, returning money to shareholders. Of course, they're doing capex. Of course, they're looking for new properties all the time. But a great example in terms of being judicious with capital would be recently where Newmont bought Newcrest for $19 billion, and Barrick passed on. They had a chance at it. They passed on it. They just said they could make no sense of the deal. I think that being judicious in capital allocation is a big difference going forward. The other thing is that the margins have greatly increased. With the price of oil coming down and fuel being cheaper, which is their number one expense, Barrick's average all-in sustaining cost right now is about $1,250 an ounce. So with a gold price of say $2,050 an ounce, they're becoming extremely profitable, and so I think that and then the other thing about in terms of being a store of value, in 2022, the Nasdaq was down 33%, S&P was down 19%, Bitcoin was down 72%. You've never seen gold lose money like that ever, and so So how did gold do that year? It was flat. So you have NASDAQ down 33, S&P down 19, Bitcoin down 72, gold was flat. So it tells you how it does during a tough year. It's a true store of value. It's a true store of value. It's something that I go to bed at night and I sleep well, knowing that we have a fairly large allocation to it. If everything goes to hell in the world, gold does great. If everything doesn't go to hell in the world, gold won't do poorly. And so I think that's why it's the world's safest investment.
So why are gold miners trading at such historic lows relative to the S&P? Is it because of the Magnificent Seven and the technology stocks that have driven up the valuation of the S&P?
Yeah, the delta between the gold miners and the S&P is clearly, because the S&P 500 is technology driven. You have the index is controlled by the 7 big tech companies that have an average PE right now of 50, and you have the gold miners that are selling at bargain basement. So I do expect, and there's always some reversion to the mean. So I fully expect the gold miners to go up in price. I don't expect that multiple of the Magnificent Seven of 50 to prevail. So I think you're going to see some reversion to the mean.
So on this chart, when looking at gold miners relative to the S&P, it basically hit an all-time high in the last 30 years in 2010. Is that because during the Great Recession, basically gold prices went up and the S&P went down?
Yeah, that's exactly right. It's exactly right. And gold typically does its best during tough times. And so yes, that's exactly right.
So when looking at this chart, you could argue that basically the market's giving you an opportunity to buy at a extremely low entry point.
Yeah, I mean, I can tell you as a value investor where I'd rather put my money, and it wouldn't be buying companies at 50 times earnings. That's for sure.
So Joe, I've represented MLPs for a big chunk of my career. And one of the knocks on MLPs is that they were really bad allocators. Anytime they had any kind of earnings boost or revenue boost, they would go out and buying sprees, much like you described with the miners. Is part of this disconnect because the miners have been bad allocators all these years?
Yeah, definitely. They had that reputation of squandering capital during gold bull markets. And now you would sit there and say, well, there can't be this collective thinking. How can they all think the same? But by the way, it's not just unique to gold miners. I think the big oil and gas producers also the same thing. I think that they have also realized their past sins, and also realized that it probably won't stay good forever. And so when you do get a $80 oil market, you shouldn't act like it's going to stay 80 forever. But I think commodity producers in general have become better at capital allocation, more conservative, and more concerned about the balance sheet.
So Joe, I'm curious. One of the tenets of capital allocation is buying back your own shares. If the shares are so cheap relative to the commodity, why aren't we seeing huge buybacks from some of the better capital allocators in the space?
Yeah, I think that well, first of all, I think some of them are buying back some shares, but I think that they have to always be looking for more product. And they that's probably one of the curses of the business model, is that they always have to have enough reserves in store to be a long-term player. And so I think that in keeping a strong balance sheet, keeping cash on hand, they want to be nimble enough to when a great opportunity does come before them that they're able to act on it.
To that end, right now, where are the largest gold reserves, and what public company has the largest exposure to those reserves?
I mean, the big ones all have great reserves. Barrick, Agnico, Newmont. I mean, they all have very impressive reserves all over the world. Mark Bristow, who runs Barrick, he can't. He's South African. He used to run Randgold, African company. He's more comfortable operating all over the world. This is a guy that flew his own plane. He flew a single engine plane from gold mine to gold mine throughout Africa, kind of a swashbuckler. And so he's a little more comfortable operating in Papua New Guinea and the Congo and Nevada and Alaska. So I mean, so I would say they're really a true worldwide company. But I think all of the big companies have impressive reserves.
Joe, one of the things you look for is insider buying. Is there any meaningful insider buying, from the CEOs or CFOs of companies?
Right. Haven't seen any real significant buying, but that's not always the most important thing. The most important thing would be ownership. So and the companies that we are invested in, there's significant insider ownership. Mark Bristow at Barrick's one of the largest shareholders of the company, and has all of his money in Barrick stock, and so that is important to us to be sure that management is heavily invested, and that there's no selling. It's bullish to see buying. It's also bullish to see no selling.
So one of the things that you mentioned were some of the places that these companies do business, whether it's Papua New Guinea or others. Some of these are not always the most hospitable places to do business. Is that problematic, and have we ever seen that as being problematic for these? And does that, again, explain some of the low valuations relative to the commodity itself?
Well, I mean, the problem is, like I said earlier, gold is really hard to find. And it's really, really hard to find. Barrick has a massive new project in Pakistan. And you say, Pakistan, wow. But I think that, I think that they assess the risk. They see what's there. They know what's there. They know what they have to deal with. But mining is, it's, hey, listen, how different is it from, I saw recently there was a massive copper deposit in eastern Arizona. And they found out it was an Indian burial ground, and they won't let them touch it. So how different is that from dealing with the Congo government? I think when you're in the Congo, you're not too worried about OSHA and or the EPA. So so pick your poison. I think one thing about mining is it's a difficult business, and a commodity like gold it's a precious metal. It's really hard to find. So I think you have to weigh the risk. And I think the other thing is, don't put all your marbles in one basket, right? Even though Barrick will have this project in Pakistan, it's not going to be, they will spread their risk all over the world, and not have too many marbles in the same basket.
Joe, because these mines are all over the world, is this another way of looking at this chart saying U.S. versus international investing? I mean, it seems like U.S. investors have been allergic to investing in international stocks. So is this, possibly another reason why people are, staying close to home during all this stress during the pandemic? Invest in what you know.
Well, I mean, most of the gold miners are all based in Canada, and Canada has very favorable laws for miners, kind of like why are all not all, but why are so many American companies domiciled in Delaware? Very similar reason why so many mining companies are domiciled in Canada. So, and I look at Canada and the U.S. as the same. The Canadian security laws are very similar to the SEC. There's very little difference. So I think, I think that, Canadian American company, with worldwide operations like Freeport-McMoRan, in copper, U.S. based, but operations all over the world. Their biggest mines in Indonesia.
Joe, could you just spend a few minutes discussing this chart? Why are miners trading at such low valuations relative to the price of gold? I mean, I understand relative to the S&P 500, with the Magnificent Seven really driving prices up for the S&P, but I really don't understand versus gold prices. Why are they so cheap?
I think they're out of favor. I think the stocks are out of favor. I think that everybody is so focused on technology. If you met a money manager that told you that they were 40% exposed to technology, you'd probably shrug your shoulders like, okay. You meet a money manager who's 40% exposed to commodities, you think he's crazy. And so, I think that they're just out of favor because the market has done so well in other areas. I think it's a temporary phenomena. I think you're going to see this chart flip-flop over the next 10 years, and nothing stays the same. I think that, I think it's just ripe with opportunity. Investor sentiment changes. Investor sentiment changes. It's funny, like when you watch these business programs on TV, CNBC or Bloomberg, and they're talking about things that have already worked. They never talk about things that don't work. And as an investor, you should be looking at things that haven't worked, not as things that have worked. And if you're trying to make money. And so I think you're going to see, investor sentiment will change. And 5 years from now, everybody's going to love gold. Everybody's going to love gold miners, and that chart's going to flip flop. So that's just the way it goes.
So, Joe, if you were to look at 2024, what catalyst do you see on the horizon that could potentially unlock value here for gold miners and get the gold prices to continue to go up?
Sure. Well, there are many factors. Let's start with the U.S. government. Let's talk about the fact that we're running at a $2 trillion budget deficit. The next 12 months, we need to fund a $2 trillion deficit for the current year. And then we have $34 trillion of government debt. About a third of that is going to mature in the next 12 months. So we have to refinance that $6 trillion plus the new $2 trillion. That's, say $8 trillion that we have to come up with. I think that my belief is that the massive debt issuance by our government, and that it's not just us. It's all of the European countries. Germany's having a bit of a crisis right now with their budget. Japan is in huge trouble. China has a huge debt problem. It's a worldwide issue of debt, and so I don't think it won't be too long until the U.S. is lowering interest rates, and that the U.S. government once again returns to the table by buying its own debt, and once again debasing its currency, which plays right into the hands of gold.
So we're concerned about fiat currencies worldwide. We're concerned about But if you're going to own the miners, then in that environment, these are still equities. Aren't these still going to get beat up?
No,
Okay.
they won't. They won't. Just go back to that chart. Gold does great during tough times, and there's always some correlation between the equities and the price of the commodity.
Well, Joe, thank you so much for joining us today. We really appreciate your insight. I am convinced that gold miners are very cheap relative to the S&P, and I'm quite surprised that gold miners are so cheap relative to gold. And I hope to have you on sometime in 2024 after some of these events have occurred to maybe see if this chart flip-flops. Thanks again for joining us.
Great. Thanks for the opportunity.
Thanks for joining Convince Me in 15 Minutes. If you enjoyed the show, please like and subscribe below. If you'd like to be our guest, please reach out to us on LinkedIn.